There are always winners and losers in any reporting season, and this half is expected to be no different.
The numbers we're going to get are going to be looking through from the 1st of July through to the 31st of December last year, and the flow through calendar year 22 was very strong. So yes, expect the numbers to be reasonable.
But corporate Australia hasn't been immune from the pain inflicted by the Reserve Bank.
In some companies' cases, they were paying less than 2%. And now today, if you were to do a refi and a 5-year loan, most A-grade corporates will be paying close to 5%. So that's a big change.
Not every business has been hurt by the RBA's 3% hike to the cash rate.
The financial stocks will continue to show some pretty strong numbers. Obviously, higher interest rates really benefits.
Almost half of Australians bank with CBA. Its results, likely to be a tidy profit, will also reveal how people are coping in a slowing economy.
And they're going to tell you the microcosm about spending of their clients, about the lending stress that they may be under, about bad and doubtful debts and what they expect, and whether or not they need to help their overall client base.
Some of the best company numbers are likely to come from consumer stocks, because even though households were hit with rising rates and soaring inflation, they still went shopping.
It's quite interesting because the consumer has been very resilient, and that's been actually the positive surprise.
JB Hi-Fi, The Reject Shop and Super Retail Group have already told the market they'll be posting higher sales, likewise with Woolworths and Coles. But those higher numbers won't last beyond this half, with the latest retail figures showing consumers pulled back spending sharply in the key Christmas period. The COVID closure and recent reopening of China will also impact corporate Australia.
We've seen a dramatic recovery in consumption in China, and naturally, with China being Australia's biggest trading partner, we think that will flow through into a lot of the travel names.
And we've holidayed more too, so the likes of Qantas and Flight Centre will be ones to watch. Last financial year, the biggest company on the ASX, BHP, paid shareholders handsomely for the record commodity prices it received. But it's also a broader economic indicator.
It is one of the biggest, baddest providers of iron ore. Obviously, it's also copper. Copper is a great understanding of how construction is going, how industrial movement is going.
Staff layoffs have been a big theme of reporting season in the US. Microsoft, Amazon, Meta all announcing they're cutting tens of thousands of workers as they tackle rising costs. Some tech players here, like cloud computing firm Megaport, have already waved the white flag.
Megaport called out this week that they're going to look to reduce costs, so that seems to be a trend across the board.
January has been one of the best starts to a calendar year for the ASX, with share prices up about 6.5% in the month. But with the economic slowdown in full force, some companies may refrain from big paydays for shareholders.
We are a little bit more cautious around dividends. I think a lot of corporates will tend to reserve some of that capacity for the full year results.
Because the next 12 months could be very tough.